let's identify the three forms of the efficient market hypothesis, also known as EMH. So the efficient market hypothesis suggests that investors are unable to outperform the stock market on a consistent basis. So the fundamental assumption of the theory, which was developed by Professor Eugene Fama of the University of Chicago, is that the current stock prices reflect all information for a company that prices rapidly or immediately and adjusts to reflect any new information in the market. The idea here is being that there's varying assumptions within the efficient market hypothesis that suggest that we cannot beat the stock market. And there's evidence at each level of the efficient market hypothesis. But ultimately, the crux of it is that it's not possible for investors to outperform the stock market consistently because information as it comes out is absorbed into the stock price. And therefore, any changes in the stock price that result from information will be completely random. This is where the random walk theory comes into play, and it suggests that it doesn't mean that the prices themselves are random, but rather changes are independent of anything that an investor can predict. So let's talk about the three forms of the efficient market hypothesis. The very center, we have the weak form. So this suggests that prices will include or can be forecasted based upon fundamental analysis. So any historical market data utilizing things like technical analysis won't have a place in the weak form. In semi-strong form, so the next level up, historical market data and information gained from fundamental analysis can be utilized to examine stocks, yet what we see here is that any public information is already encompassed into the stock price. Therefore, investors can't gain an edge based on fundamental analysis because the idea is that someone else has already done this analysis and effectively changed the stock price when they did so. And then lastly, the strong form is suggesting that historical market data, fundamental analysis, as well as insider information, none of these will enable an individual to gain an edge in the stock market because all information, both public and private, is already incorporated into the stock price. So even if someone were an insider in the company, and although it is not legal to trade based on inside information, the idea is that no one can effectively outperform the market even knowing inside information, because somehow this is all still incorporated into the stock price itself. So the relevant information, just to recap for each of the levels, for the weak form, insider information and fundamental analysis can be used to gain an edge. With semi-strong form, only insider information can be utilized to gain an edge in the market. And with the strong form, nothing can be used to gain an edge in the market. Now, on occasion, there will be instances where we'll see some phenomenon occur in the stock market that cannot be effectively explained by the efficient market hypothesis. We call these stock market anomalies. And there's a variety of anomalies that are discussed in the module text, but we'll go over a few of the main ones here today. So the first is the price to earnings ratio effect. So the low PE effect is what is generally known. So the idea is that when you are investing in stocks with low price to earnings ratios, this is the best way effectively to make money in the market because you're purchasing stocks that are deemed to be undervalued and holding them till they appreciate in value. And studies have shown that generally low PE stocks do tend to outperform high PE stocks over a long period of time. Therefore, this is an anomaly that effectively can't be explained by the efficient market hypothesis. The small or neglected firm effect notes that companies that have fewer analysts following them. Smaller companies tend to not have that much of a following with analysts, simply because they're not necessarily followed by the broader stock market. So over time, though, there is this tendency for smaller companies to outperform larger companies when they ultimately survive. So the variability of returns, on the other hand, when it comes to investing in small cap stocks versus large cap stocks, is significant because smaller cap stocks tend to have a higher risk factor than large cap. The January effect is a phenomenon that occurs primarily, as the name suggests, in the month of January. This is noting that stocks tend to decline in the month of December and then all of a sudden are back higher or normal back in the month of January. Really, this is the result of a lot of investors either selling and or buying securities throughout the month of December, trying to get up to the point of the end of the tax year for income tax purposes to try and offset gains or losses, etc. So that's the reason why you see that volume of selling going on in the month of December, and then things returning back to normal in January after things had bottomed out. Again, an anomaly that can't be explained by the efficient market hypothesis. And then lastly, the value line enigma is the value line researches stocks initially and then gives a rating for their timeliness. So 1 being the highest rating, 5 being the lowest. And research has shown that studying the stocks that rank 1 over time has provided superior results, but frequent trading will increase transaction costs and effectively reduce returns.